Right.
And there's really kind of two components of global liquidity when measured like that. One is the rate of credit formation, and then the other one is the strength of the dollar, because the global liquidity is often measured in dollars because a lot of the liabilities internationally, as I previously mentioned, are denominated in dollars, and so that dollar component is pretty important. And so you can either get more rapid credit creation to improve global liquidity, or you can get a weaker dollar around the margins, and that can improve global liquidity because you're basically changing the denominator at that point. Um,
Yeah.
and so I do think that in the years ahead, we'll probably get another positive liquidity cycle. We've been in kind of a stagnation there for a period of time as central
Hmm.
banks try to tighten. I think we'll probably get another move upward, and I would expect, as a base case, for Bitcoin to do pretty well in that
Yeah.
environment.
Lyn Alden, a highly respected macroeconomist and investment strategist, has gained prominence in the cryptocurrency space for her insightful analysis of global financial markets and emerging technologies. With her unique blend of engineering and finance expertise, Alden has become a leading voice, particularly regarding Bitcoin. While critics might argue that Alden's positive stance on Bitcoin is excessive, her views are grounded in extensive research and a nuanced understanding of both traditional and digital finance. In a recent interview, Alden elaborated on why she believes global liquidity is ready to flow into Bitcoin and the broader crypto market. Alden identifies global liquidity as one of the most significant correlates with Bitcoin's price. She breaks down global liquidity into two main components: the rate of credit formation and the strength of the dollar. Looking ahead, Alden anticipates another positive liquidity cycle in the coming years, following a period of stagnation due to central banks' tightening policies. In this environment, she expects Bitcoin to perform well. Furthermore, Alden notes that as Bitcoin becomes more widely distributed and held, its volatility should decrease over time, enhancing its attractiveness as a store of value. This trend could further fuel the influx of global liquidity into the cryptocurrency market. Alden points to several indicators that support her view of increasing global liquidity entering the crypto space. One significant development she highlights is the recent large-scale Bitcoin purchases by IBIT, which is BlackRock's Bitcoin fund, now a major player in the crypto industry. These substantial acquisitions signal growing institutional interest and confidence in Bitcoin as a long-term investment. Another key indicator Alden discusses is PayPal's entry into the cryptocurrency market with the launch of PYUSD, their new stablecoin. This move by a major financial technology company represents a significant step towards mainstream adoption of cryptocurrencies and could potentially attract more global liquidity to the sector. Alden believes that these developments, coupled with the potential for increased global liquidity, could create a favorable environment for both Bitcoin and the wider crypto market in the coming years. As more institutional players enter the space and traditional finance continues to intersect with cryptocurrency, the influx of global liquidity could accelerate, potentially driving further growth and adoption in the crypto sector. Now, let's listen to more clips of Alden to understand her view better.
Right.
And there's really kind of two components of global liquidity when measured like that. One is the rate of credit formation, and then the other one is the strength of the dollar, because the global liquidity is often measured in dollars because a lot of the liabilities internationally, as I previously mentioned, are denominated in dollars, and so that dollar component is pretty important. And so you can either get more rapid credit creation to improve global liquidity, or you can get a weaker dollar around the margins, and that can improve global liquidity because you're basically changing the denominator at that point.
Yeah.
And so I do think that in the years ahead, we'll probably get another positive liquidity cycle. We've been in kind of a stagnation there for a period of time as central
Hmm.
banks try to tighten. I think we'll probably get another move upward, and I would expect, as a base case, for Bitcoin to do pretty well in that environment. Yeah, so historically, Bitcoin and stablecoins have kind of been the two killer apps of crypto, right? They're the two things that have really caught on with traction through bull markets and bear markets alike. Bitcoin is an emerging store of value. Basically, it has superior monetary properties than most other monies we're familiar with. But because it's still small, it's still not widely held.
Hmm.
People try to build leverage on it. It goes through these cycles. It's volatile as it reaches its whatever its total addressable market is, or as it gets close to what it eventually will be. Stable coins are just dollars in digital form. It helps serve the need for dollars globally, the demand for them. And there's really, so far, there's two main use cases of stablecoins. There's one that's basically the unit of account for, trading and, DeFi on various crypto platforms. A lot of that's going to be on Ethereum. And then the other big usage of stablecoin is basically demand for dollars in the global south. Much of it's satisfied by Tron. So there's almost like two different worlds of the same asset. As a near-term temporary store of value, like working capital, that's where stablecoins are very useful. Basically, the ability to tolerate volatility is somewhat of a privilege. Basically, the more financially comfortable you are, the more you can say, I'm willing to hold something for the next 4 years. Whereas stablecoins, you can kind of think of them as your checking account if you're in one of those environments where dollars are useful. So thus far, network effects have been shown to matter. Liquidity kind of begets more liquidity. And so far, Tether's network effect in this has been pretty remarkable, probably stronger than I would have guessed. I've also been watching some of the yield generating stablecoins, or you can kind of think them as tokenized T-bills, things that try to pass on the yield to the holder rather than the yield being captured by the issuer. And even them, I mean, they've grown, but they're not exactly capturing market share very quickly. And so network effects are clearly pretty strong among stablecoins. And I don't have a firm view on how many there'll be or how much those network effects will entrench, because some of it is like a Boolean outcome of regulations, So some of the onshore ones try to, turn the arm of the state against the offshore ones, and you kind of go back and forth there. So there's some outcomes that I wouldn't try to predict. I do think it's rational for these various entities to try to get into the stablecoin market, given how big and potentially profitable it can be. But it's hard to judge the outcome.
Lyn Alden emphasizes the critical role of stablecoins in the cryptocurrency ecosystem, describing them as dollars in digital form. She identifies two primary use cases for stablecoins: meeting the global demand for dollars, particularly in emerging markets, and serving as a unit of account for trading and DeFi activities on various crypto platforms. Alden points out that stablecoins, along with Bitcoin, have been the two killer apps of crypto, maintaining traction through both bull and bear markets. She notes that while Bitcoin is an emerging store of value with superior monetary properties, stablecoins fulfill the need for a stable unit of account and working capital in the crypto space. And as you know, Nvidia's quarterly earnings are upon us, which can fly the AI and GPU cryptocurrencies, so let's see what Lyn has to say about them.
Oh, I think it's going to go way higher than it is now. I think one of the biggest challenges is to determine who makes money from this. So far, a lot of companies, they're kind of questioning, well, are we actually making money from all of the GPUs we're buying? So obviously the GPU makers are making money. And the question is, how much money will be made on the other side of it? This could be one of those quiet revolutions where the biggest winners, other than the GPU makers, are basically just various companies or individuals that have productivity increases from this. And so this is a long-term productivity improvement, because kind of like how automation made blue-collar labor way more efficient. Basically, one worker can do the work of 3 or 5 or 10 workers. We can see a similar thing in white-collar work, which is that a smaller number of professionals with all these AI assistants can do more white-collar stuff, and that is a productivity booster for the global economy. I think that's going to be probably a big factor. And so far, we've seen somewhat of an anti-economy of scale along with an economy of scale, in the sense that obviously the leading models, the leading AI companies have tech that's ahead of their competitors, but then we also find that they're more heavily filtered and moderated to the point where some of their either objectivity or their usefulness is impaired despite their technical advantage, whereas some of the more open, more decentralized ones, their tech might not be quite as leading edge, but then they make up for it with fewer or more reasonable filters. And so that seems to be a trend that probably is going to continue.
So Lyn believes even though these GPU projects lack the potential tech, but considering this Nvidia trend, these projects are going to benefit immensely. Also, AI assistants are going to make things a lot easier for people considering ChatGPT and other AI projects getting adopted at mass level. Now we can say that Lyn Alden anticipates an imminent market rally based on several factors. She expects increased global liquidity, a key Bitcoin price correlate driven by credit formation and dollar strength. And that's all for today. If you enjoyed this video, please give it a like, subscribe to our channel, and hit the notification bell so you don't miss any future updates. Thanks for watching, and stay tuned for more.